Okay, so welcome to people who are just joining in for our next instalment in the GS HPA and HPF webinars. Now, well, I think I said this last week actually, that we're quite a few weeks in now. I think we started these at the beginning of May, so we've got quite a lot of content. If you are joining us for the first time, all of our webinars up to date are on our YouTube channel. So you can go back and catch up on any of those, and there's all sorts of topics in there. From last week, John Finlay was talking about, with Ian Howley, was talking about open loop design, experiences of designing and installing open loop systems. That was really good, and we're going to be doing a further series on that later in the year. Next week, we have Bean Beanland talking about the responsibility of heat pump installers to manage their subcontractors. That's part of in an MCS context, so that's in conjunction with the MCS. And then the following week, we've got David Boone from the British Geological Society talking about how to make the most of BGS geological data in any heat pump designs that you might be doing. And then in September, gosh, that's coming around really quickly. We have Edward Thompson talking about Route to Net Zero, which is all about fiscal background and the cost of gas versus the cost of electricity, and how we need to overcome those barriers in order to get to electrification of heat. And we've got now a programme expanding to the end of October, so plenty more content coming up. But today we have Chris Toes talking to us. He's the Head of Energy Services at Utility Team. I will let him introduce himself shortly. He's going to be talking to us about the impact of COVID on the UK energy market. So really relevant, really up-to-date topic. So looking forward to hearing this. So it's now 1:05, so I'm going to hand over to Chris. As usual, if you have any questions for Chris, please do put them in the chat function. I'll be keeping an eye on those, and we will do those at the end of the session. So Chris, I'm hand over to you. Thank you.
Thank you, Laura, and good afternoon, everybody. A slight change in topic. It sounds like you've had some quite technical heat pump related webinars of late. So hopefully this will provide some insight on some other topics for you. So who am I and why I'm here talking today, and why are we members of the Heat Pump Federation is probably a reasonable place to start. Utility Team are a utility procurement specialist. So we support industrial and commercial consumers buy gas and electricity, helping them through the procurement process, developing trading strategies, agreeing performance initiatives with the suppliers. We also support them through the ongoing management of the utilities, so any compliance through ESOS or other schemes, deliver environmental audits for them, again help them with risk management, and all the kind of day-to-day things you have around some of the larger, more complex portfolios, multi-site portfolios in particular, with changes of tenancies, bill validation, subtenant billing, that type of thing. We help them to monitor. Very difficult to manage anything unless you understand what it is you're dealing with. So very, very supportive of rollout of sub-metering and AM&T technology. We've got some quite clever kit now where we're able to help customers understand their energy consumption at a very granular level, which is particularly important for property management companies, manufacturers and the like. But my real passion sits around the final box in this slide, which is reduction. So we have a pool of preferred supply chain partners who we introduce to our customer base to help them identify, develop and deliver energy conservation measures, particularly around renewables. So very keen on renewable generation, decarbonising the customer's generation and site. We support power purchase agreements through large solar and other generating assets, and help them with their sustainability planning. So quite a broad brush. The size of our company, so we've got about 6,000 sites that we look after across about 1,600 customers. It's ticking up a bit actually. We've had a few large deals land of late, and we trade around 1.5 terawatts of gas and electricity per annum. So a fair chunk of consumption there. Some of our customers, I'm sure you'll recognise a fair few of these names. We seem to do particularly well in the large property management space. So Amy, Wembley Park, Workman, some of the biggest FM and property management companies in the UK. Manufacturing, large retailers, that large complex portfolio, again, seems to be somewhere we do particularly well in, and had some recent success with some sporting clubs as well. So we've just picked up Leicester City Football Club and Wasps Rugby Union. So, a bit of preamble, that's who we are. A reminder, I'm not sure how welcome this is, but we've all been living it since the beginning of the year. Some of these key dates fit into some of the slides I've got to show in future, particularly around price movement. So just a quick spin through this. So really not a particularly welcome start to the year, hearing about the outbreak in China. First case end of Jan in the UK. Boris published his plans to deal with the pandemic early March, which didn't take long actually to get into lockdown. I didn't. It's easy to forget these dates, but absolutely, 23rd of March we went into full lockdown. 11th we had the Queen on the telly giving her first ever Easter message, and then some easing May 10th, and then really out of lockdown, mostly out of lockdown, kind of 4th of July. So really a good 2 to 3 month period where people were staying home, businesses closed, ramped down production. But actually there was very much a lead into that, and I think we'll talk about that more a little bit on the next slide. So looking at UK power market, to begin, it's probably just worth looking back a little bit. So if you look at the back end of 18 was a particularly challenging year, particularly towards the end of the year, Q3, Q4. We saw very high energy prices off the back of high oil and carbon markets. There was a lack of gas in the system, and gas, I'm not sure if gas is a particularly favoured topic of the Heat Pump Association, but it's one we have to talk about, I'm afraid. There was low gas in the system, and gas being one of the primary fuels for electricity generation, really did push price up towards the end of 18. That eased off moving into 19, and looking back now, it would appear that 19 was actually quite a stable year. So we saw energy trading around 50 to 55 pounds a megawatt on forward base load. Moving into the kind of topic of today, so the COVID period, we actually had a really mild winter last year. So we had very strong surplus gas, strong gas storage, very mild winter, so lower demand than typically would have been expected. And I was thinking about this earlier, I don't actually recall scraping my windscreen once at the back end of last year or over the winter period. So very much reflected in the price. So we saw a ticking down of price into December 19. And then end of December, obviously we had the first COVID announcement, and very, very shortly afterwards we saw first China and then certain parts of Asia go into some form of lockdown. Now, because these are global markets and predominantly these fuels are traded globally, and we're a net importer of our fuel, it does impact UK energy market price. So we saw the market start to tick down as the spread of lockdown came towards Europe. That sort of bottomed out around the 40 pounds a megawatt. People were starting to become more concerned around the pandemic. So prior to lockdown, we started to see a lot of changes in behavior, which resulted in reduced demand. And then moving into kind of March, really, which was a critical point for Europe. Spain, France, Italy, certainly Italy were the first to respond. We've seen further decreases in consumption, therefore leading to surplus supply, lack of demand, put further downward pressure on price. So actually the market, looking back at end of October 18, trading at nearly 70 pounds a megawatt hour, was actually pushing 35 pounds a megawatt hour March to April, when Europe really was in the throes of its lockdown. Nearly all of the major European countries were in some form of lockdown during that period. So cheap energy prices, you'd think this would be a very good time for consumers to go out and forward hedge their positions. Agree new supply contracts, particularly if they're coming out of a 2018 contract, they've got a 2-year deal, we're now in 20. Actually, it's a great time to renew. Prices are at an all-time low. We'll come on to what the experience was around that in a second. As you can see, as we got sort of comfortable with lockdown, market stabilised at around the £40 a megawatt mark, ticked up as we headed towards July. Fair to say there's been some jitters around that recovery. Again, a slight dip. Let's not forget, during this period of lockdown, we had some quite sensational weather, again, which always pushes demand down in the UK. Obviously, with office blocks not operating as well, a lot of summer load typically would sit with cooling plant, which wasn't necessarily running. So we've seen quite a lot of reduction in demand over this period. We'll go into a little bit more detail around that shortly. But certainly, I suppose the theme is beginning of the year, market dropped off moving into Q2. Q2 was pretty flat, but at a real low. It started to trend upwards as Europe's come out of lockdown, albeit confidence clearly hasn't returned and full demand hasn't returned, as there's a bit of instability in those prices. We think it'll settle in forward months around the £45 a megawatt mark. Looking at other markets, you can certainly see the correlation between power and gas market. So very, very clear correlation in the table on the left. Again, following the themes of what we've just reviewed. Other markets to note, in the top right-hand corner, we have crude oil. So there's some more commentary around perhaps the perfect storm we saw moving into the spring around the oil price. But you'll recall being stuck at home, for those of you that haven't already invested in an electric vehicle, very cheap prices at the pump, but nowhere to go. So we didn't quite perhaps benefit as much as we would have liked for those reduction in oil prices. But absolutely, there's some more commentary around that coming. Coal price, we're not particularly reliant on coal at the moment in the UK, so it's not a massive contributor. But again, you can see some reduction as demand's decreased and the coal prices come off, again ticking back up as we move towards summer months. And the carbon price absolutely fell off a cliff, much like the oil price did when Europe was in lockdown. So a lot of people had overhedged, so they've covered their position. They don't need the carbon credits because they've wound up their operation or reduced their operation. So there was clearly surplus carbon credits in the market, which caused that huge slump. But we have certainly seen recovery of that again as Europe has come out of lockdown. So some very, very clear trends around what's happened in the power and commodity markets there. The clear drivers behind that, so touching back on oil again, so you'll recall the OPEC and Russia had a bit of a price war in March, both failing to agree production cuts as demand was slumping, which caused the price to plummet. Eventually, an agreement was reached 12th of April, which saw that price then steadily recover once those reduction in output started to take effect. We saw record price lows across Europe and Asia, again directly related to demand. Very interesting, this graph. So again, you can really see the correlation between lockdown, who went first, how strict their lockdown was. So certainly Italy, you'll recall, had a nightmarish scenario where they had to enforce some very, very stringent lockdown measures, and that is absolutely reflected in their energy demand across that period. So an actual reduction of around 25%, which is very, very significant. France almost followed suit, again, a stricter lockdown than perhaps we've experienced in some other European countries, certainly in Britain, and Spain following suit shortly afterwards. Those where the lockdown hasn't been quite as strict, you can see that there's still been quite a significant impact on electricity consumption. So between 15 and 20%, I would say, Europe-wide, between sort of March and May, and that's eased as these countries have come out. None have yet really returned to pre-COVID levels or expected levels for time of year, which suggests that certain industries are struggling to come and reopen and get back to some sort of business as usual. Some good news. So during the time of lower demand, the renewables picked up a greater share of the generation mix, which is going to help decarbonising. So the grid over that period was less carbon intensive than it would have been under kind of normal operation. And interestingly, we saw a rise in negative system prices. So negative system prices where the operator for the grid balancing system, which makes sure there's enough supply and demand on the system, and they balance that out. Because supply was greater than demand, they've actually had to demonstrate a negative system price where effectively they pay a generator not to produce. So here's some money, turn your plant off, please stop generating power. Not unusual. We do see negative price on the system fairly regularly, but nowhere near to the extent that we saw end of March. And in April, there were record instances of negative pricing on the system. So really does demonstrate lockdown impact on demand, supply. We're actually paying people not to generate. So moving on, again, this is some data that I've pulled together around what's making up that UK generation mix. I picked a couple of dates at random, so I went for 2 p.m. end of Jan, year-on-year comparison here. So I suppose really the main message again is just to reinforce the total demand megawatt. Yeah, we were only consuming 79% of the power that we had been consuming 12 months previous, again, directly attributed to, I suppose, a milder winter would have impacted that. This is not all COVID related, but also people starting to make preparations, perhaps traveling a little bit less at that time, but also of the makeup in there. So you can see a massive decline in coal consumption, which is fantastic news. Coal is absolutely being phased out. Nuclear typically sits as baseload on the UK grid. A massive drop-off in CCG, so combined cycle gas turbines or gas power plants, in essence, across that time. Very, very healthy contribution from wind. Obviously, wind and solar are very intermittent. Wind particularly is sensitive, so the grid has had to become more adept at balancing and short-term kind of ramping up and down of generation to respond to differences in wind generation. So those really are the key messages around that, but ultimately it's that reduction in demand of around 20%. Looking at a end of the first month of lockdown, well, we were a week into lockdown at this point. So again, a 17% drop year on year, reasonable weather around this time of year. So the key difference here is the wind wasn't blowing. So some of the slack was picked up by gas, and actually some increase around coal plant there. It looks as if Drax and biomass had scaled up a little bit there. Whilst the wind wasn't blowing, the sun was shining, so we had good contribution on the grid from solar. But actually, you can go through this data, and this data is available on a half-hourly basis for every single measurement point of every day for the last 10 years. You can download this online. You could run 200 of these models that will all tell you a slightly different story. But in essence, UK is predominantly reliant on gas to generate. Wind and solar can make up around 30%. So we can do around 30% of the UK demand via renewables, albeit it's very intermittent. So the balancing act around that is becoming increasingly challenging. There are some developments, particularly wider rollout of electric vehicles will support that, should support that if we can get smart grids in place. But we've also seen increased short-term operators or peaking plants, along with some larger scale battery systems now being deployed to deal with that transition between high or low renewable output. So we very much have our focus based on the consumers. So whilst we keep a very watchful eye on what the market's doing and the drivers behind that market, ultimately the customers are our charge. So understanding how this has impacted our customers, we spent a lot of time talking to them, visiting them, not so much actually, but certainly doing a lot more webinars during this time and talking to them about what the impacts are on their commercial operations. So almost all of our customers in some way, shape or form have either had to significantly reduce activity on a manufacturing site. They may have perhaps kept a skeleton crew on to keep things ticking over. Others, we've seen total site closure, 95% of staff on furlough, everybody sent home. So obviously this has had a major impact on their revenue streams and short-term cash flow. The result of that was that many were asking for the types of payment holiday which perhaps individuals were offered via their credit card provider or banks and the like. This facility wasn't forthcoming from energy suppliers, and I've got a lot of empathy for suppliers during this time. Energy suppliers, hedge a position. They commit to sell power commodity to a consumer. The consumer uses it. They then bill a month later. They then maybe have to wait another month to collect that revenue in. So they've got quite a high cost of working capital, considering how far in advance they're buying or securing and then supplying and then ultimately collecting the revenue for the energy that they provide their customers. So it was pretty much a straightforward no. You can't have a payment holiday, you can't have a payment break. So unfortunately, we saw a significant number of our customers either paying late or not paying at all, which has caused quite some significant issues that we've been supporting them and the energy suppliers to address. Where a customer has chosen not to take a kind of fully hedged position and they trade their energy requirements on a flexible basis, therefore effectively they have a shopping list, if you like, and they have to go out and buy month ahead, season ahead. They buy in advance of delivery point. Where they hadn't fixed a position and they knew their forecast was going to decrease, we've managed to reforecast that volume, so they weren't effectively over covered on their hedge. Where they had already hedged, we've had to kind of reforecast and unwind that position, which has exposed some to some market exposure. If you buy it at £50 a megawatt and then actually you don't need 50% of it, but today's price it's only worth £30 a megawatt, then obviously yes, you can sell it back to market, but you can't get the same price that you bought it for. So the suppliers would have incurred some costs around there. So it's always better to do these types of things in advance, which is why a strong dialogue with our customers and the energy suppliers was really important during this time. Unfortunately, and unsurprisingly, I think it's fair to say, if you look at the nature of energy suppliers, certainly the big six, they have very, very large call center operations. They're not particularly adept at mobile working. Certainly a percentage of their staff will be mobile and be able to work from home, but the vast majority won't. So that transition from the office space to working from home did take some time. So in some instances, it was kind of 4 to 6 weeks of quite significant disruption, which with regards to kind of dealing with billing queries or customer account queries or trying to renew contracts or obtain contract pricing, proved extremely challenging. It also unfortunately coincided with record low energy prices. So the ability for customers to take advantage of that low energy price was somewhat hindered, albeit we did manage to get a majority of our deals closed to allow our customers to take advantage of that. So I've already touched upon that, the kind of impact on customers, the impact on suppliers. What is the response from suppliers to be? And this is really important to note. And actually, you know, all of our customers will have a requirement to buy gas, electricity, oil, you know, some kind of fuel to run their operation. They have to buy it from somebody. It's utility. It's one of those distress purchases you can't get away from. There are going to be some changes in the way we have already seen some changes in the way suppliers are offering the market. So aside from the reduction in service levels and query resolution, we've seen a real tightening of credit policy. So customers now are finding it harder to be approved for forward contracts. We've certainly seen restrictions in payment terms already implemented across the board. So there's been suppliers tend to like 14-day or 10-day direct debit payment terms anyway. Some have ruled out 28 days back payments altogether now. It's kind of BD only on some stricter terms, so they can identify any potential debt issues earlier on. We've also seen some increased risk premia embedded in supplier prices. So whilst we've tracked the market down, we would expect where we've priced something the month before, we've seen a big decrease, we've priced it again, we would expect to see that reflected in the prices offered on the day. That hasn't always been, well, I think the wholesale price has been passed through, but we've picked up on increased premium being added to that price to offset the increased risk they've got of forward trading, those power arrangements. And we've also seen a reduction in trading horizons. So typically a lot of suppliers will go out up to 60 months ahead. So if you're buying electricity for today, you can buy it 5 years in advance or anywhere within that horizon. We've actually seen a lot of trading horizons really restricted. In fact, EDF, I think, they reduced their forward contract to 3 months for a period, just while they were making their adjustments to be able to get back to some sort of standard trading horizon. Unfortunately, and this is of genuine concern, we are now seeing a lot of suppliers refusing business from certain sectors. And unsurprisingly, that's very much hitting the hospitality sector. So accommodation, restaurants, pubs, theatres, all the things we like best, unfortunately, now are perhaps haven't yet, but will find it very, very difficult. Perhaps when they come back off furlough and start to reopen and their energy contract is pending, the amount of offers they're going to receive are going to be significantly reduced, and the terms of those offers are going to be less favourable than perhaps what they would have received 12 months previous. We've also seen a removal of certain products. So previously suppliers were quite happy to offer a no standing charge product, a kind of daily fee for that supply. That's now been removed from a lot of suppliers. So all suppliers now want a standing charge, which kind of offsets any imbalance in volume, and no volume tolerance. And there's a piece on volume tolerance shortly, which again is very important and something I wanted to stress today. A volume tolerance typically is an agreement for how much power you're going to consume over an agreed period. Typically, you have a tolerance which you can operate within without penalty, but there is some focus on that shortly. So not a great story around suppliers, but again, a lot of empathy for them. They've had to, as we all have, had to respond to some very challenging trading environments, and certainly the bigger ones. Nobody's used to a 20% reduction in UK energy without a major event. I think the last one we saw was kind of Beast from the East. Was the last major event the UK experienced where energy markets were thrown into disarray for a short period. But certainly on the scale and size of what we've seen through COVID-19, we've not had anything touching this in the past. So again, back to what utility team have done to help our customers. Well, understand your current commitments and liabilities in your supply agreements. So we've been working with our customers, and every supplier has a slightly different set of T's and C's. There are certainly some common themes in there. But it's important to understand the fine print to ensure that customers don't have a nasty surprise, and that if they are anticipating one, we are approaching the supplier and trying to negotiate a favourable outcome prior to the event. It's always easier to deal with these things in advance. We spent a lot of time trying to source alternative suppliers where there have been credit issues. Again, that's an ongoing battle. We've certainly seen a rise in requirements for stricter credit covenants now, security deposits and reduced payment terms, as I've mentioned previously. Trying to bring customers to market. So whilst we're very busy trying to help the customers keep the doors open and deal with some of the billing challenges they have, it's still a great time to buy. We can't get away from that fact. So we've been encouraging customers to come to market. And as I've touched upon, we've been working through the late payment and debt issues, reinforced asset consumption to acknowledge where we are and what we're doing in the short to medium term. We've also helped a fair few of our customers by providing some funding through our revolving green fund, which seamlessly links me into the next slide. So the funding mechanism, I won't spend too long on this, but in essence, it's a forward rebate. So utility team have some preferred payment agreements in place with suppliers. What that enables us to do is to release funding against future energy spend. So in the example on the right here, you can see it's a 3-year contract term. Customers currently paying 14 pence a kilowatt. We know the market's moved in the right direction, so actually the pence per kilowatt's decreased. We've managed to negotiate a rate of just under 12 pence, or say 11.5. Onto that 11.5 pence, we've added a premium. So we've put an uplift on there to round the pence per kilowatt off at 12 pence. So you've got this premium on every kilowatt the customer consumes for the next 3 years. If you times that by their anticipated consumption, that effectively creates a pot of cash that the suppliers will release to us either on contract signature or on contract go live. We are then able to refund that to the customer. So effectively the customer gets a cash out upfront on their future energy spend, and the thinking has always been that the customer invests that in energy efficiency technology. So in the past, we've deployed this cash to fund LED lighting refurbishments, on-site generation projects, perhaps not fully fund, but maybe to partially fund or to cover some of the business case and development costs. Again, partial funding for solar schemes. We've done it for consultancy work again, so it's actually a really good place to deploy the cash is around building a carbon strategy and net zero roadmap out for sort of 3 to 5 years. And that funding is readily available, obviously very dependent on the customer's credit position. Certain suppliers won't offer the function, but we have 6 or 7 suppliers that will. We just need to be mindful that the customer then doesn't go and reduce their consumption by 50%, and then the anticipated cash the supplier was going to recover doesn't arrive. So we need to forecast any impact of spending that fund into their future energy consumption. But a good, strong dialogue with the customer helps us to do that. So that's something on the funding, which I believe certainly Federation members are able to access. So very happy to take any calls around that. Back to the take or pay piece, again, I touched upon this earlier. So very simply explained, you commit to make a purchase. I'm going to buy 1 million kilowatts next year. The supplier will say, great, I'll sell that to you for 10 pence a kilowatt. By the way, you're allowed to use within 20% of what the agreed rate without penalty. So in the example I've given here, so you can use up to 1.2 million kilowatts in a 12-month period without penalty, and you can use as little as 800,000 kilowatts without penalty. If you go outside of these tolerances, you are exposed to potentially to some kind of volume tolerance penalty. Traditionally, and I've spent a long time working for an energy supplier, a large energy supplier, they typically don't enforce this clause, because for every consumer they have which perhaps uses a bit more energy than had been anticipated, another consumer in their portfolio perhaps uses a little bit less. So we've not really had a great deal of enforcement of this clause in the fixed price kind of mid market sector, industrial and commercial. It's only ever really enforced in the very largest intensive consumers, or actually in a flexible procurement strategy where they are buying direct from market, then it's reconciled on a monthly basis. So I've been canvassing suppliers just in the last few weeks around their, I mean, there's no getting away from it. We've seen the trend, UK's decreased energy demand by 20% for 4, 5, 6 months in certain sectors. So they're absolutely going to get to the end of the year or their contract anniversary, and they will be outside of these agreed tolerances. The supplier is not going to have the benefit of that portfolio effect because that's happened across the board. So my fear, certainly my suspicion is that suppliers will have to, they won't have any option but to go out and enforce a take or pay. Now, in this instance, because it's under recovery, the supplier typically, and there is some variance in this across suppliers, but typically what will happen is the supplier will charge up to the minimum annual tolerance at the prevailing contract rate. So if in this example given, the consumer uses 500,000 kilowatt hours as opposed to the contracted 1 million, the minimum take or pay is 800,000. The supplier is well within their rights to go back and land the customer with a bill for 300,000 kilowatt hours at their existing contract rate. So effectively the customer is paying for energy that they did not consume. This is of grave concern. So as I said, I've been canvassing the suppliers. Some are being quite tight-lipped around this. I'm sure some are thinking around how they would enforce this. Bit of a PR disaster, but I suppose if they're all doing it, then everyone's just as bad as each other. They have to protect their businesses though, so that's why they have these clauses in contract. Some of the smaller suppliers, where they're far more sensitive to this under recovery because they don't have the portfolio effect, have already quite proactively come back to say we absolutely will be enforcing take or pay clauses. So this is something, perhaps a topic of conversation that I know, Heat Pump Federation members will be looking at. Energy bills, very important to understand the cost pence per kilowatt of what the customer's currently consuming. It's often a topic of conversation. This is something that we're absolutely making customers very mindful of, without kind of fear mongering at the moment. But as we're doing that exploration into their current terms and conditions, this is very much a hot topic, which we're then trying to have that conversation with the supplier to work out exactly how exposed they are and what the potential implications could be. So where are we? So price stack, that said, after everything I've just said, the price of energy doesn't actually make up a significant amount of the energy bill the customer has. So displayed on the right hand side here, there's some forecasts Ørsted put out Q3, Q4 last year. Actually pretty accurate. Anticipated that the wholesale energy cost was going to level out around £50 a megawatt, or 5 pence a kilowatt, which was not unfeasible. However, impact of COVID, we saw that drop down to 35. Since then, it stabilised at 45. All of these other energy costs on here are not related to the commodity charge. They're related to subsidies and support for renewables. We've got assistance for areas with high electricity distribution charges, one of my favourites. So that's, you know, people off the grid or at the very edges of the grid to ensure that they can get a steady electricity supply. And then you've also got support for the transmission network, which is the kind of main motorways, if you like, of the distribution network, and then the more local distribution networks. So TUOS, which is transmission use of system, and DUOS, which is the distribution use of system charges in there. So the customer is only able to, by buying smart, influence about 35% of their actual delivered energy cost. The only way they can genuinely reduce their energy cost is not to consume the kilowatt. And this is a trend which is set to continue. So non-energy costs are forecast to increase about 4% year on year. Yes, we've seen evidence of the wild fluctuations you get in the wholesale market, but if that's only making up, even if the market spiked, you'd still struggle to see that rise above 50% of the total delivered cost. So again, it really does reinforce the importance of customers not consuming, as opposed to just trying to buy at the right time to offset those future charges. There's also quite a significant changes in some of the charging methodology, which unfortunately customers have become victims of their own success by managing to avoid certain charges through TNUoS charges through the triad methodology. The grid has Ofgem has decided that we need to move back to a more fixed pricing methodology, which is going to add around £300 million a year to UK business energy bills, mostly impacting larger consumers. But again, it will impact all consumers because the way that the charges are being implemented are changing. And at the moment, we're just talking to our customers around what the impacts and how they can perhaps offset that. But again, reinforce the message, the cheapest kilowatt's the one you don't use because it costs nothing, which really does reinforce the need to reduce energy consumption. So a fair bit of information. I hope there's some questions off the back of that. I was thinking around how to kind of close it up and summarize it, and there was lots and lots of negative messages I could have put out. We had the horrendous news around the recession yesterday, albeit there are some green shoots and around recovery, potentially quite a quick recovery. Job losses impending, 700,000-800,000 again, I heard this week. But let's try and find some positives out of this. So I did hear someone coin the phrase retrofit Rishi. So we've got the 3 billion Green Recovery Fund now, which will be spent on improving efficiency in homes and across public sector, schools, public buildings across that estate, which I'm hoping certainly will be somewhat of a boon for Heat Pump Federation members. Air quality has improved significantly across the period. I'm sure we all noticed it. Apart from it being a lot quieter, it was nicer to breathe, and I don't think my garden's ever looked so good. That was very, very noticeable, and I think that absolutely there's been some changing attitudes around that. We've had a period of time to reflect now. And certainly, we don't just talk to energy and environment managers, we talk to FDs. And I can absolutely assure you that there are changing attitudes in the boardroom now. We really are seeing energy efficiency, reducing carbon. It really is being pushed up the agenda. Yes, they've got all these other challenges that they need to address, but I think this has been a genuine shot in the arm, a real wake-up call for UK business to recognise that actually we need to act. It's the right thing to do. And actually, if you get the commercial terms of the agreement right, long term, it's very, very beneficial to your organisation. The other good news story, and I don't know why the two examples I showed earlier showed us consuming coal on both the time points that I chose, but we've actually gone about 60% of this year with no coal generation in the UK energy mix whatsoever. which is fantastic. Coal's going to be phased out entirely by 2025, so they're just ramping down or perhaps getting the last knockings out of any existing plant. But the no coal on the grid really is going to help the UK grid to decarbonise. Electrification of heat, of course, is essential to continue that journey. That's quite a lot for me, I think, for now. So I will hand back to whoever's going to pick this up, perhaps Laura.
Yes.
But thank you very much.
Thank you, Chris. Thank you so much, and thank you for finishing with the positives. It's always good to end on a positive note, so thank you for that. There was just so much in there, not just for people who are involved in ground source heat pumps, but for anybody actually involved in the energy market anywhere. So I'm going to make sure that the slides, as well as being on the GSHPA website and our YouTube channel, will also be sent out far and wide to anybody else who wants to see them. So thank you so much for presenting all that information. So if anybody has any questions, please do put them in the chat. We've got 15 minutes, just for, well, maximum 15 minutes just for any questions. I had a couple just to kick things off while people are having a think. So Chris, I know you don't have a crystal ball, and I'm not expecting you to have a crystal ball, but I just wondered, with the information on how the electricity gas prices have changed in the past, do you have a view on how the spark gap might change going forward, which is the difference between electricity price, which for us is very high, and gas price, which is very low? How do you see that changing, if at all?
It's a very challenging one, isn't it? I think I can speak personally. I think we absolutely need to stop subsidising gas. That really will drive the decarbonisation of the UK forward a lot better. Interestingly, when I showed the cost stack for what makes up a kilowatt hour of delivered energy, that isn't reflected in gas prices at all. So some sort of levelisation around contribution to network and grid and carbon tax perhaps around gas. There isn't anything imminent. I mean, it is, you know, UK is still commissioning and signing planning off for large-scale gas generation in the UK. I'm not convinced. I think, you know, hydrogen's come back. There's been a lot of noise around hydrogen again in the last couple of weeks. It's a longer-term investment. It's not without its complications. I think that I'm going to be in agreement with all of your members that actually that spark gap needs to shorten. I used to sell combined heat and power for a living. That's not going to win me any friends, I'm sure, on this webinar. But it's ridiculous. You know, you've got a spark gap of 6 to 1. You know, your CHP can pay back in 18 months, 2 years. I mean, that's how do you compete against that? It's ridiculous. You need to put some controls in place. So it's going to come through support. I think it's going to come through legislation. We really need to drive this forward. At the moment, though, I'm not anticipating any decrease in that spark gap. You can see the correlation between the gas and power markets. It's very, very clear.
Absolutely, yeah. So just a more basic question, actually. Why is it that the electricity price is built of so many different levies like CCL and GEOS, and yet the gas market isn't? Is there a reason for that?
I'm going to say that's well above my pay grade. I think it's a conundrum, is it not? I think it would certainly make sense to have some similar type of charging mechanism in the gas price. Perhaps even share some of the electricity price or some of the charging methodology in there. It needs a bit more joined up thinking. I think there is continued support for natural gas. I'm certainly an advocate of seeing some change around that charging methodology. But no, I am not currently aware of anything pending around that, disappointingly.
Thank you for that. Well, I think with the HPF coming together, hopefully we can have a bit more lobbying force with the government and those who set prices. So, yeah, watch this space, hopefully, and having you on board will certainly help that. Thank you. Just one other question from me. You mentioned on the price stack slide, which I think was the one before this or the one before,
yes.
You mentioned the best kilowatt hour is the one you don't consume. Obviously, that's the one. We or the government are very keen on the electrification of heat. And obviously, as the HPF and the GSHPA, we want people to come over to the electrification of heat, which essentially means using more kilowatt hours. So I'm not putting you on the spot here at all, but so how does the electrification of heat sit alongside the aim of not consuming the kilowatt hour?
Well, because you offset it very simply but through renewable generation. I think if you think of it on a domestic scale, that's heat pump plus solar plus maybe a battery. Don't know. I'm not entirely convinced either way on batteries at the moment. I think it presents perhaps a bit of a recycling challenge a bit further down the line. But actually, if it's second life batteries coming out of the car market, there's going to be a surplus of those in a few years' time. Perhaps it does help to balance that. How does that work on a larger scale? Well, actually, I've looked at some pretty big ground source heat pump schemes. COP is very, very good on that. And if you can support that with some renewable generation, then you're not as reliant on that import kilowatt from grid. And again, I think that decentralization piece. And I used to sit on be a member of ADE as well, as part of my old career. But I think it's about doing things at a more local level rather than be reliant on this national infrastructure, pushing electricity hundreds of miles where it incurs significant losses, etc. Try and support more localized energy schemes, district heat networks and the like. Big fan of district heat networks, but make sure they're being supported by a range of technologies. I think if it's standalone heat pump, of course it's going to have an impact on your energy price. And actually, if you compare that to what a traditional gas solution might look like, I think people at times are going to struggle to make the investment. If it's supported and packaged and wrapped together with a host of other measures and interventions, and actually we've still got a very, very long way to go to make buildings efficient. Loads of stuff we can do, and actually people often see that as pretty boring stuff around just making sure that buildings are efficient as they can before you start sizing generation assets. I've seen so many mistakes where people have just rushed to go and buy the big lump of generating assets. It's exciting and it's got a good payback, but ultimately what they're providing power to, or what they're heating, is an inefficient building. Absolutely make the building as efficient as you can before you're sizing any generation asset. So again, if I had all the answers, I would have hoped to have retired by now. But it's it's not one thing; it's lots of things. But absolutely, I think we've got a long way to go with the retrofit side of things. I mean, I'm still coming across estates where there's so much to go at. Even for just building controls and building management systems and simple insulating pipes, and just there's lots and lots of more that could be done and should be done to reduce that kilowatt hour consumption. I think you can certainly offset any increase in import requirement from a heat pump by delivering other initiatives across a customer site. Very confident in that.
Yeah, that's really great. Yeah, because I mean, I think a lot of people who will be either listening now or listening in the future will be well aware of many plant rooms and many buildings that they've been to where horrendous things are being done or haven't been done that are very simple. So yeah, absolutely. I think I'm a big fan of holistic solutions. So it's not just the heat pump, it's the whole package of measures and how it all works together. So yeah, that is a really good point. So
it is. I mean, I've worked for some pretty big ESCOs, and actually I think that there is a challenge around there, because the lead time between project identification and spade in the ground delivery can be 2 years, 3 years in some instances. Now actually your members, it's about finding a balance of big, long-term, big scale projects, but also making sure that you've got smaller projects where the lead time perhaps isn't so long. You can deploy packaged equipment, so you've got steady revenue. That it's so important. And actually, I think the large public sector schemes or town centre district heat networks, everybody wants to be involved in them, but actually there's not many organisations that can stomach a sales cycle or a development cycle of 2 or 3 years without actually receiving any revenue. So it's again, haven't got the answers to all of that. It's about trying to find a mix. But I think particularly for heat pump market, again, it's a challenge because we've touched today on one of the most stressed industries we've got now are hotels. I don't see heat pumps being deployed at hotels as much as we could have done. I'd love to see, a nice, simple kind of, not off the shelf, but something we can deploy at speed. It's a package solution, supported with some financing mechanism, perhaps a heat sale agreement, full operation and maintenance. It's around getting that commercial offer in a space where we can sell it, because customers are interested. They really are, and I think actually making the argument now against the alternative, and if the alternative is natural gas, I think it does put us in a stronger position coming out this side of the pandemic.
Yeah, absolutely. And again, another positive message. Definitely, I think the concept of having this long-term development plan. I mean, I used to work for E.ON, and we used to do that kind of thing where you'd start off with the easy, low-hanging fruit, which is the installation, and then you move on to the bigger scale. But yeah, you're right, absolutely. That you've got to have those businesses out there that can stomach the cost of doing that. And maybe if you have multiples of small companies coming together who all do their own little bit, and then they get paid and go away, then maybe that's a good way of doing it. I don't know, but yeah, I think we're in a much different position now to how we were 6 months ago, 7 months ago. So yeah.
I'm still trying to work out exactly what that position is, but and maybe I won't. But it certainly feels like a different space, that's for sure.
Yes. So we've got no other questions at the moment. But thank you everybody for joining us, and thank you to Chris for presenting that, because it was really, really informative. So Chris's email address, he's just very helpfully put up there. Thank you. So I'm sure, Chris, you've put it up there, meaning anybody can get in touch with you if they've
Absolutely.
got questions. And of course, you can always contact any of us at the GS HPA or the HPF via the normal route, via the website or our emails. So thank you again to Chris, and hopefully we will see some of you next week, same time, 1 o'clock on Zoom. Thank you. Bye.
Thank you. Bye-bye.